Okay, yeah, thanks again, folks, for coming. I do appreciate it. We are a little bit early, like I mentioned, 11 minutes. We'll start at 3:30 Central Time. Um, Up on the screen here, we've got the Sierra chart program, and I made a couple of charts that have some funny lines at the bottom, and I want to explain what they are because I want to put this in context of why we're really doing this event, or one of the reasons why we're doing this event. And if you have questions about it, um, please feel free to share. But here's what we see. So left-hand side, E-mini S&P, middle 10-year note, right side 30-year bond. Okay. At the bottom, in what we call region 2, we have an average daily range in points. So this is 15 points for the E-mini S&P as an average daily range. Look at that number. That number has significantly dropped off. That coincides with the lack of volatility we've seen in the stock market lately, right? So the average daily range has fallen. All right, in the 10-year note, the average daily range, we quote it as a fraction of 30 seconds. So 15 and well, an average. This is between two tick values, but basically 16 of 32, which is about a $500 calculation. I'll explain that in a minute. And then over on the bonds, one handle and 4.5 ticks or so. So I wanted to put these up here because there's a misnomer in the trading community that interest rates are boring. And that is not the case. Interest rates do a lot of volume at the exchanges. Everybody look down here at the 10-year note. Right down here at the bottom in the middle, on the right-hand y-axis of the 10-year note, that's the volume of the 10-year note today. And to the left here, this is the volume of the E-mini S&P. So the 10-year note has traded more volume than the E-mini S&P today. That is pretty telling. All right, there's not a lot of volume in the E-mini S&P right now because the market's going up, and people tend to trade a little more lightly or a little less actively when the market's rallying like this. So the interest rates are definitely an attractive place to be if you're looking for a deep market, if you have concerns about liquidity, if you don't want to trade gold or crude oil because you don't like getting lots of slippage, or you don't like trading those single digit bid or offer type contracts, then you may really want to look at the interest rates. Now the black line you see here, okay, this black line is the average daily range that we see above, but in dollars. So I did a multiplier here to show you what does this number actually mean. Well, in the S&P, it's about $750 or $770 roughly. The 10-year note's a little bit less. It's about $500 average daily range. So it's still reasonable. It's not like it's an insane market that is untradeable due to an enormous daily range, but about a $500 average daily range over the last 20 periods. Over here on the bonds traded 240,000 contracts roughly. That is a very, very tradable market, whether you're a spread or an outright trader, and it has a higher average daily range in dollars. All right, so as an example, on the bond contract here, if you had bought one and sold, theoretically you buy the low, sell the high. Of course, that is very, very unlikely. This is the amount of money that you make, or if you did it the opposite, you'd lose. So there's enough range in there for a day trader to trade in. You don't have to trade the E-mini S&P, to be an active futures customer. Okay, it's an interesting thing, and a lot of people sort of write off the interest rates. They just focus right on the E-mini S&P and never look at anything else. We believe that to be a mistake. All right. 2-lot, 3-lot, right? I mean, if the margins are very flexible. I mean, we'll talk about that a little bit today. Jonathan will talk about it, I'm sure. Infinity does have a very flexible day margin policy. For those of you guys who are active intraday traders, if you do want to trade that way, Infinity has a lot of flexibility. We go down to about $500 a contract, okay, on the indexes, currencies, and interest rates. That is very aggressive. All right, that doesn't mean that you should pop 20,000 bucks into an account and start trading 40 lots, okay? It's not what we are intending, but we like to illustrate our flexibility. This is not a side project for us, so we don't have a history of just, raising the margins every time we see a little volatility. It's just not in our DNA. We're a futures-only firm. We're highly specialized. We have a narrow range of services, but we like that because we're really, really good at doing this, and we argue that If you're going to trade, the riskiest type of markets out there, then trade them with a firm who specializes. And we believe our policies about risk reflect that. So yes, S&P, interest rates are up here. I mean, you really could do this on any market. You just have to adjust the multiplier. So just to give you an example, if you wanted to, make this chart here a gold chart, I could duplicate this chart. So I would just right click, duplicate the chart. That makes a copy of it like this. I'll just squish it down so you can see it. We can easily change the symbol to June gold. So now we have a daily chart of gold. And the only thing we need to do here is we'd have to make an adjustment to the average daily range because the gold market trades at $100 a point instead of $50 a point. So significantly higher average daily range in the metals, or in gold in this example. But gold's also a thin market, and you want to be careful with it. But it's a great market. Obviously, it's been taking a beating here for the last month or so, about $80 drawdown in gold. But we definitely, it's very easy to manipulate these charts like this. So this is gold. We do offer, spread trading. So, there's going to be a lot of discussion here about that today. Najmo, a couple other people asking about that. So we honor any exchange recognized spread for margin purposes. So you can't place the order as a spread with our program, but you can easily chart the spread. Jonathan will talk about it. I'll show a little bit of it, coming into the session here. And we will honor any exchange recognized spread for margin purposes. So if you have positions that deserve a margin discount at the end of the day, you don't have to do anything special. Our system reaches into the CME's margin calculator and pulls out a number that is automatically applied to your account. That's one of the reasons why the margins are so much more flexible here. And that's one of the reasons why a lot of people who trade this style of trading trade with Infinity rather than some of the bigger firms who sort of treat futures like a side project, like Thinkorswim and some other places that are very, very uncompetitive when it comes to margin and pricing. I made this little document. I'll show this now. If somebody wants to see this as a reference later, not a problem. So the other day, over the last month or so, I've been calculating some spread margin quotes from our clearing firm, and you can see that I put those here on the left, and then I put the outright margins if you weren't treating it as a spread here on the right. So sorry about that. So as an example, let's look at this. Let's look at this one here. If you're trading, this is a really popular one, the ultra bond against the regular bond. There's a $1,980 exchange minimum margin, but if you treat those as two separate legs, it's 10 grand. Look at this one down here, the Dow against the S&P. If you want to be long 6 Dow and short 5 E-minis, $7,800 margin requirement. If you treat those as outright futures, $52,000. So there's a significant difference in trading with a firm like Infinity who will honor exchange recognized spreads. We believe that to be very important. It's not even close. I mean, this is a question of the efficient use of capital, and do you want to be able to deploy it elsewhere, or do you want to have it tied up with the broker all the time? Hey, thanks, Stacy. Appreciate that. Good to see you. We are going to record everything, and barring any unforeseen issues with GoTo here, we will have it up on YouTube within a day or so. William, the CME publishes the exchange recognized spread. So their site is not the easiest to use for some of the more obscure stuff, but the interest rate ones are actually pretty clearly listed. Once we get going here with the presentation, I'm going to go I'll track down that link and I'll post it here for you. Correct, David. That's right. We have some pre-made chart templates for you, Stephen, and some other folks who are asking about that. Once we get going here, maybe after the event, we'll give you some instructions, and then to contact us in the office here, and we'll send you a couple of good examples of how you can create spread or fly charts using Sierra. Yeah, and if anybody wants a copy of this document as well, let us know. I'll give you some instructions near the end here on how to get all this stuff. We'll get it all over to you. And for anybody who doesn't have a demo version of our program, we encourage you to register for a trial. You can do that. It's free. It has, the simulator has live data. It's a great way to get a feel for the program. It doesn't cost any money, and we can put all these interest rate markets and a bunch of other stuff in there for you. See, David, there really isn't, because so David's asking, are there issues because we're legging into the spread? Does that create a margin problem? It really doesn't, because we have such flexibility with the day trade margin anyway. So it's very unlikely you run into a margin situation because we offer $500 margin on the indexes. So in theory, and the interest rate. So in theory, if you're trying to leg into a 10-year note position and you have a position limit of 20, and even if you only had $10,000 in your account, that's something you could be enabled for. So really unlikely you have an issue with that, David. All right, so here's what we're going to do. I'm going to do a quick introduction here. Let me just bring my screen up. Give me one moment. We're going to have Jonathan come on and start talking. I'm going to hang back in the background here and answer questions that are related to the brokerage and margin and risk and things like that. So I'll be here still helping you out. Let me just bring my risk page up here real quick, and then I'll put the screen back on. Okay, so let's get started. Folks, trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. So folks, just be very careful with the fact that this should only be risk capital. Okay, only deposit risk capital into a futures account. That means money you can afford to lose without lengthening your retirement horizon or affecting your lifestyle or the ability to pay the bills. Be especially careful with things like day trade margin. That term is thrown around a lot in our industry. Even if you use the regular margin per contract when you trade, you're still using a great degree of leverage. So be very careful in terms of using day trade margin. What I want to do is get right into it with Jonathan. Jonathan has we've been on each other's radar for quite some time. Recently, we were put in contact again. He had been talking to some of his students about using a program like ours that offers the ability to use, the flexible margin per contract, and also for the overnight margins being using the exchange recognized spread margin. And that's sort of what linked us together. I started watching his videos. We started making some together. We trained him a little bit on how to use Sierra, which I think he's really getting the hang of. And really, we believe there to be a void in our sphere here for this type of trading. We don't really deal with a lot of people who trade this way. So we thought our customers would be very interested. Jonathan's been very upfront with his students. I've gotten a lot of good feedback. So we're feeling really good about the whole setup here right now. And we want to give him a chance to get in front of our customers a little bit and say what he has to say. So Jonathan, I really appreciate you making some time. I know you're a busy guy. Thank you so much for doing this. I will go ahead and make you the presenter here. Take it away, and I'll mute myself for now. And folks, if you have questions that are more related to Infinity, please feel free to ask.
Great, Patrick. Thank you, and happy to be here, guys. Can you guys hear me okay? Do I sound okay? Just help me with a little sound check real quickly. I would appreciate that.
That sounds
great. Thank you. Fantastic. Hey, guys. Lots of familiar names on here, which is awesome to see. Yeah, so welcome, everyone. We're going to be talking about bonds. Reached out to Patrick. Our approaches are definitely synergistic, and I think you'll see in short time why it makes so much sense of why I'm constantly suggesting clients, students to come over and check out Infinity. We do a lot of spread trading, a lot of relative value trading. So let me just quick read a risk disclaimer from my side, and we'll get right into it. So trading or investing carries a high level of risks and not suitable for all persons. Before deciding to trade or invest, carefully consider investment objectives, level of experience, and ability to tolerate risk. So I'm not going to go through the whole thing, but just to get it out there, I think we all know these are educational presentations. Whenever I talk about specific levels, it's just where I see value in the market. Finally, normally in my presentations, I will incorporate quite a few more testimonials than I will in today's presentation. Regardless though, any of the testimonials, guys, they're from select customers. Their experiences may not be typical of what you can expect to achieve. They're not solicited. All the testimonials are just emailed to me, okay? So just throwing that out there. And I'll also keep the chat up throughout. I'll answer questions as long as it doesn't really kind of break the flow of the overall presentation. And then we'll get going, okay? So what we're going to talk about today, what you're about to learn from me in this next 60 minutes or so. I think this is the most exciting trade in the markets. And actually, trading firms are built on this one trade, okay, this exact trade. And I've personally been able to work with and teach over 100 professional traders in this exact trade. So hopefully that gives you a little bit of comfort in this approach to trading bonds. I'm also going to speak definitively about this trade because I think it's important to understand. And it's important to understand because, at least in my opinion, there's a right and a wrong way to trade bonds. Many on the internet teach bonds, but what they're teaching, at least from my experience, is wrong, maybe even flat out dangerous. So if you trade bonds right now, any of the interest rate products, it's really important to see this. And then I just ask to keep an open mind. If you don't trade bonds, you don't need any experience to start trading bonds. It actually will help coming in with a blank slate. So today I'm going to show you a unique approach to valuing and trading bonds without crossing your fingers and hoping for the market to move in your direction. I very rarely will speculate or guess on the overall direction. What I'm always going to do is look at something relative to something else. I'm a big believer that everything we do, whether it's buying a home or buying a phone, everything we decide is done relative to something else, right? You buy an iPhone because it's got cool bells and whistles relative to another phone. It's got a good price relative to another phone, but yet many trade looking at things in isolation. And to me, I just don't really understand that. So we're going to be looking at everything relative to something else. A little background, just so you know with certainty that I'm speaking from direct experience. I also want you to see how I'm different. Been trading for 18, 19 years now. And I spent 8 years as the director of trading for a bond futures shop. We only traded bond futures. It was a proprietary firm. I was the 6th employee. We grew it to over 100 employees before we sold out in 2010. Also a level 2 CFA candidate. Like to welcome everyone. I always like to do this. Thank you all for joining. Let me stop here and ask if you can just show in the chat who here trades bonds right now or trades any one of the interest rate products right now. And as the replies come in, I'll keep yapping and then we'll go back. So again, I've seen a few others teach how to trade bonds on the internet, and what I'm about to show you, you'll immediately see the difference. But again, it's about having an open mind. There's a lot of nonsense taught out there, and I get you're probably thinking, okay, here's another guru coming to talk to us. But hang with me, okay? Give me the benefit of the doubt, and like others before you, you'll see. Your interest will be piqued, and what's really important, it makes sense. And it's different than anything that you're doing right now, okay? To be analogous, it's like, for option traders out there, for anyone who trades or teaches options without talking about the importance of volatility, you probably want to stay away. Options are all about volatility. Same with bonds. If you're technically just trading ZB, hopefully you'll understand in a few more slides, that's climbing a very steep hill. So let me just go into the answers now. Okay. I would say about 50-50, kind of skewed because I have a lot of bond students on here as well. Okay, some have had problems trading in the past, a lot of 30 years, some sim trading. Cool. So lots of bond traders. You guys will love this. This also might sound a little pompous, but it's not intended to be. I haven't seen anybody else teaching this, so it's going to be a little bit unique. This is going to be for any trader, anyone risking money in the market to achieve whatever individual goals that you're looking to achieve, okay? It's going to be simple, straightforward, and I'm going to break this process down. To be clear, guys, at the end, for those interested, I'm going to show you how we can get more with advanced training. And more will be everything you need to take this training to the next level. For some of you guys, this offer will make absolute sense, and that's great. I look forward to working with you. I also want to say, if it doesn't make sense, I'm thrilled that you're here. Absolutely no hard feelings whatsoever. And also, thank you, Infinity, for having me. Infinity Futures has been really wonderful to me and my members. Infinity Futures is really a perfect fit because Infinity is the only future brokerage that I know that handles margin correctly, just like Patrick was talking about. So I'll explain more on that later, but once you see the difference in margin, you'll see why I reached out to Patrick and the guys over at Infinity to let me present. Infinity, great firm. My email address, you can just email support@activedaytrader to get to me. So this whole thing is, imagine if you learn a specific trade and that trade gave you kind of a go-to place to really learn, okay? And imagine if that trade was so interesting to you that you put everything else that you're learning on the back burner. So picture that, because if that was really the case, what I found at least, that can inject a newfound energy into your trading, okay? What I'm always going to ask whenever you're doing a trade, and what I want you to start thinking of is why? What's the reason that you're long oil or short oil? Is it just because you have a feeling that it goes higher? Because that's not real, right? That's not really sustainable. So start asking yourself why. And that's a question that we're going to really dig into today. So I want you to understand the benefits of being in the right markets. Because right now the Fed has started to move. As Patrick was saying, liquidity is coming out of the S&Ps. And right now, at least in my opinion, the fixed income is a really good place to be because there's quite a bit of movement. So here's a picture from, what's this? This is the NASDAQ futures pick. I started in the business in '97 trading NASDAQ futures. Okay, right out of school, I had no idea what I was doing. But in the first year, I was able to make a whole bunch of money. And I traded NASDAQ during that time in the green rectangle. Okay, the trade was amazing. It was volatile. It had real edge. But once the NASDAQ settled down, we went from being able to make money for 4 years or 5 years in a row to volatility being sucked out and nobody could make money. I wasn't able to make money for 6 months once the volatility left the market. So at that time, I left trading NASDAQ to go trade fixed income, right at the time where the Fed started moving rates. But the reason I did this is because you don't want to trade a bad market. You want to trade a market that's moving around. We need that as traders. I started trading fixed income in 2003, right around the time the Fed started raising rates from 1% up to 5.25%. And then right after that, the Fed turned around and lowered rates from 5.25 down to 1/4. This is why fixed income was such a good trade between 2003 and 2008. And during that time, I was trading so many fixed income contracts that the Chicago Mercantile Exchange was flying me all around to their best events, playing with Natalie Golbis, the LPGA pros, and then Tiki Barber up there at Baltusrol Country Club. But again, it's because the Fed was in play, interest rates were in play, but right when they stopped moving, that market died. And for me, I went over, started trading options. I was a market maker on the floor of the Chicago Board Option Exchange, and I was doing that because of the exponential growth in the options market. My whole intention of going through kind of this background is, for one, so you can see that I'm not just another marketing guru out there, but it's to show you the importance of being in the right trade. You don't want to sit there and continue to trade something that's not moving and always say it's the market's fault, it's the market's fault. Markets are going to evolve. We just have to learn to evolve with them. So again, right now, in my opinion at least, the Fed's in play. The Fed is moving rates. To me, in play just means movement. Movement is volatility, and volatility is opportunity. Now, volatility is going to be, sure, a little bit more risk, but as traders, if you take a step back, what we're really looking to do, what the trader does, the trader looks for inefficiencies in the market and helps keep the markets in line. That's really the role of the trader. The trader is not to guess which way oil is going, whether it's going to go up or down. Traders are looking for little inefficiencies. And that's exactly what we do when we're looking at fixed income. That's what I do when I trade any market, but specifically fixed income today. 3 secrets to trading bonds. For one, bonds are a puzzle. Once we learn to put that puzzle together, it's going to make a ton more sense. Being in the right bond is key. Whenever I ask who trades fixed income, I always get a lot of ZBs or TLTs. I'm always going to ask why. Why the ZB and not the 10-year? Why the 10-year and not the 5-year? Why the 5-year and not the ultra? Many don't even realize that the 30-year, the ZB, it's not really a 30-year bond. Well, Daniel, they all have leverage. They all have leverage, but the ZB, it's not really a 30-year bond. It's closer to an 18-year instrument. The 10-year is not a 10-year, it's a 7-year. The 5-year is a 4-year. All little kind of intricacies of learning how to trade bonds. And then finally, learning to put positions on, learning to do the work beforehand, and then having patience, trusting the work that we've done. So let's get into interest rates and bonds. Now, when interest rates go higher, prices go lower, okay? The majority know that. I'm going to walk through and just explain why. Not that we really need to know this for the futures trade, but it's cool and we should know it. So when interest rates move higher, bond prices move lower. Here's an example that explains why. Let's say I buy a 30-year bond and I invest for 30 years, I get 3%. Yippee. Now, I own that, I get 3% a year. All of a sudden, in this phony baloney example, if interest rates on the 30-year shoot up to 10%, I'm still holding my bond that only pays 3%. How am I ever going to get out of this darn thing? Well, the only way I get out of that is as those interest rates move higher, the price of my bond moves lower. So maybe if I bought it for $1,000, now maybe I sell it for $100. It matures at $1,000. Whoever bought it gets the 3%, but they also buy it for $100 and it expires at $1,000. So that example is how they move in different directions. Now if we get into the futures, let's talk about the bond puzzle, okay? And this is absolutely key. And in order to explain this, I'm again going to be a little analogous, and I'm going to talk about diamonds. Let me also be clear, I don't know anything about diamonds. I just think this is a good example before we get into the bonds. So let's say all of us on this presentation are going to a flea market, and we're all going to a flea market together. It's a one-day flea market, and all they do is transact in diamonds. They transact in 1 carat, 2 carat, 3 carat, and 4 carat, okay? Prices, they're not set by anybody, right? It's just pure supply and demand. So we go to this flea market altogether. 1 carats are trading for 1,000, 2 carats are 2,000, 3 carats are 3,000, 4 carats are 4,000. 5 hours later, we're all walking together in our big posse, and the prices start to change just based upon supply and demand. And the new prices, the 1 carats have doubled in price, the 2 carats have doubled in price, the 3 carats are up 25%, and the 4 carats have doubled in price. This is how we need to look at bonds. Because one thing we know, just from this example, what do we think is the cheap one? Right? It's just pure supply and demand. The 2 carat and the 3 carats are trading for the exact same price. That doesn't seem like it's going to be sustainable. It seems inevitable that the 3 carat is going to trade for more than the 2 carat. But based upon supply and demand, it just turns out that they're trading for the same price. But maybe we decide, hey, the 3 carats are probably cheap right now. And if we want to make an investment, we would invest in the 3 carat because we can see a little kink in the curve, in the little diamond curve that we made up. Okay? That's how we need to look at fixed income. But instead of looking at diamonds, we're looking at the yield curve. And we're looking at the most liquid contracts that trade on the yield curve. And in front of you, the ZT, it's the 2-year. The ZF is the 5-year. The ZN is the 10-year. ZB, 30-year. And Ultra is 30-year plus. But we're not looking at whether the bonds are going to go up or whether they go down. We're not trying to guess what Janet Yellen's going to decide and then speculate. Instead of that, we're going to look at the difference. Just like in that diamond example, we're looking at the difference between 2-year and 3-year diamonds. When we trade fixed income, we're looking at the difference between 5s and 10s, 10s and bonds, bonds and ultra. Okay? This trade is actually the exact trade that the Chicago Mercantile Exchange teaches on the site, on their site. Earlier, somebody asked what the exchange spreads are. They're right in front of you. They have silly names. The tough 2s, 5s. The tut is going to be 2s, 10s. The tub is 2s, 30s. Fight is 5 10s. The fob, the knob, and the bub. All silly names, but these names are pretty actively known in the Chicago community. Okay, so you can go to, I'll put this page in the chat as well.
I just put it in there again, John, so we should be okay.
Oh, cool.
Yep, it's
Thanks,
there.
Patrick.
Mm-hmm.
So yeah, so what they do is the Merc will give us this information, and then they give us the relationship. Okay, and this relationship is like it's called a DV01 relationship. It's trading, like think of it as delta neutral. So Daniel, you were saying ZB earlier has leverage. Well, if you want an equal amount of ZB to ZN, which is the 10-year, 3 ZN is equivalent to 1 ZB. That's the relationship. Okay? And then when we're trading the yield curve, we look at all these different spreads. And so right now, we're going to go into an example of the 5-year spread against the 10-year. 5-year, excuse me, note against the 10-year, and that spread is called the fight. Okay? Now, let's say this happens. And let's talk price. This isn't yield. Even though it says yield, let's just talk price. Let's say the yield curve looks like this. Okay? Go back. Let's say the yield curve looks like this, but all of a sudden, some hedge fund blows up, or China comes in and sells a whole bunch of 5-year future contracts and 5-year futures go lower. That doesn't mean the 10-year is going to go lower. The 5-year just went down because of pure supply and demand. Maybe a hedge fund blew out. They had to sell all their 5-year future contracts. Well, traders, keeping the market efficient, will look to buy the 5-year, and simultaneously you can sell the 10-year because it's like a little hedge. It's a quasi type of hedge, but you're trading the relationship. So think of a rubber band. A rubber band you can pull, 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 pull. Inevitably it's coming back, right? The 5-year is not going to trend one way for 2 months or 3 months straight, and the 10-year is going to trend the other way. Now, okay, I don't want to say it's not going to. It doesn't. It hasn't in the past. Of course, anything can happen in the future, but nevertheless, what I want you to see is when there's what we call a kink or an inefficient in the pricing of the curve, it's going to present trade opportunities. Same thing, and this is the really cool part about this trade, because we can look 5-10s, 2s-5s. Right here, I'm going to show you a butterfly, and a butterfly is the 10-year, how it's valued against the 5-year and against the 30-year. Okay, somebody buys a whole bunch of 10-year, it's going to get expensive relative to its neighbors. You could sell the 10-year if you choose. You could sell the 10-year and buy the ZB. You could sell the 10-year and buy the ZB and buy the ZF. I personally like to do the relative value trades because for me, I feel like it's a lot less risk, but there's still plenty of opportunity to make a bunch of money if it goes your way. Same thing with the bond butterfly. I think you guys get it. One gets expensive, one gets cheap. It presents a trade. Now I'm going to go into some charts. We're going to look at Sierra charts. We're going to look at a bunch of these examples. It's going to be confusing. I'm going to tell you right now, the objective of this is for you to see what's really out there. And for those trading just ZB or curious about bonds, I want you to see that you can learn this, and there's a ton of different things we can do. I'm not trying to confuse you at all, but don't be thrown off if you're way confused. It takes a little bit of time to learn. Okay? Matt, does any single one lead the other? Nah, I mean, I would say the 10-year is the alpha male, but no. The answer is no. But overall, for me, I find the 10-year is the alpha male. So what I did here, guys, Sierra charts, I highlighted the contracts that we're looking at. So right now we're looking at the fight, the 5-year against the 10-year. And this is what it looks like going back to April 27th or April 26th. And it just moves like this, okay? They move. People think interest rates are boring. They're not. People think spread trading is boring. My spread traders out there, my advanced bond students, do you think that spread trading is boring? Do you think that bonds don't move around at all? As those answers come in. So what we're looking at here, if we sell here, we're selling the 5-year and buying the 10-year. Okay? Down here, if we buy, we're buying the 5-year and selling the 10-year. Okay? That's how we look at this. We don't look at it in isolation. We're not only looking at 5s, 10s. I just want to show you what 1 5-10s charts looks like. The time period of this chart, it goes back to April 27th. I think it's like 15 minutes. A bunch of bond students saying that they move. These things definitely move, okay? It is not a boring trade, that I promise you. So guys, as far as the charting goes, this is something that I've been working with Patrick. So Patrick's got access to all the charting. We've been working on this together for the last couple of weeks, okay? Because these charts, you need to learn how to put them together because there's factors, okay? What we're looking at here is 5s against 10s, just the difference. You could do two lines, look at one against the other. I think it presents better if we look at it one minus the other. Let's go to the next chart. I told you it's going to be a little confusing at first. I just want you to see what's available. Knob, green, it's going to be 10s against 30s, 30s against ultras. So the left is the green area right here. The right is going to be this chart right here. What I want you to see with these two charts is think of it just looking at the green line up here and the yellow line up here. If this spread was really strong and goes way, way up here, and this spread is really, really weak, goes way down here, can you see how that would present an opportunity? They would be moving in completely different directions, and they're pretty close together on the overall yield curve. If you did both of these together, and let's say you bought this first chart and sold this chart, you'd be buying 10-year, selling 30-year, selling 30-year, buying ultra. Okay? What that's going to be is it rolls you into a butterfly. So the way to transact, guys, is how we always suggest transacting is for the knob, the 10-year against the 30-year, or let's do the bub because it's one by one. All you would do is put a limit order for a 30-year. Once you got filled, then do a market order for the other side. Okay? You can't do the knob as one ticket. Okay? Some futures brokers have a spreader. They're all horrible. I wouldn't use them at all. The spreading is not sophisticated enough to use. So you would do this as buying a ZN, you put a limit order in. Once you get filled, go market order and sell a ZB. You'll find yourself in this spread. Okay? These are trades that we do all the time where we're buying a spread against another spread. What we have here is just the ZB butterfly. Now the ZB butterfly is just going to be the knob against the bub. Buying the 10-year. So right here, if we want to sell this, we're buying the 10-year and selling the ZB and buying the ultra. What I want you to understand with this chart right here, we're looking at the relative value of the 30-year future contract, how it looks against its neighbors. So right here, the ZB is expensive, but it's only expensive relative to the 10-year and relative to the ultra. Down here, the 30-year is inexpensive relative to the ZN, relative to the UB. Okay? So for those who are just trading outright, for those who are just trading ZB or ZN, something like that, what I teach and what I recommend is if you're looking to sell bonds because you think interest rates are going higher and you see the ZB butterfly is down here or down here or down here, you don't want to sell the ZB. You definitively want to sell the ZN or the UB because those are expensive. That's why it's all about getting yourself in the right contract. So even if you think rates are going higher and the ZB butterflies down here, don't sell ZB. You're better off trading the ZN. Okay? Hey, John. So there's always, these are liquid contracts, guys. These are very liquid contracts. The cool thing about fixed income trading, especially for those who are in different time zones, the market's active 23 hours a day. It's active during the European Open, it's active during the Asian Open, and it's open all the time. So that's the ZB butterfly. So this is from today. These are trades from today. Went back to April 27, April 27 here. This chart here is showing the ZB butterfly. This is showing the ZN butterfly, and you can see today the ZN was expensive relative to the ZB. So if you're looking to short an interest rate futures contract, this morning the ZB was offered, right? It's on the low end of its range. You don't want to sell the ZB. You want to sell the ZN. Ideally, the trade would have been to sell the ZN and buy the ZB, and then you find yourself in the knob. Really cool things. You can dig really deep into the trade, but at least from my experience, this is how professional traders, professional fixed income shops are built, on this exact trade. Okay. We got here, this is just 5-year butterfly. You can see how the 5-year is getting weak relative to its neighbors going back over the last 2 weeks. Again, if you're looking to sell something, I wouldn't sell the ZF. Look how weak the ZF is relative to its neighbors. Okay? It's all about finding ourselves in the right futures contract. That's the most, whenever you're doing any of these kind of relative value type trading, and again, I do this with fixed income. You can do it with gold against silver, corn against wheat, oil against oil. Oil's got a curve as well where it goes out 3 years. Oil, you could trade WTI or you could trade Brent. If you want to sell oil, why do WTI? Why not consider Brent? 2 different options. We just want to make sure that we're always doing analysis so we find ourselves in whatever contract's expensive if we want to sell, or we want to find ourselves long whatever contract is inexpensive if we're looking to buy. And that's what this exercise really is. It takes you through the entire yield curve so we can figure out where we want to be short and where we want to be long. And then we can back into a position. Another example. This is a great example. So what I'm showing you here, 5s all the way out to bonds. It's all of this. It's a ton of duration. The more years that you have between your spreads, the more risk that you're going to have, the more movement. Same thing with those who trade 2-year or 5-year versus the bond contract or the ultra. The bond contract or the ultra is going to be way more volatile. But think about it, put your common sense hat on. It makes sense why 30 years is more volatile than 2 years, right? There's more uncertainty. So the further you go out in the yield curve, the more movement you're going to see. So again, this top chart is going to be 5-year all the way out to 30-year. The difference in the yield. So if 5-year is trading 1% and 30 years trading 3%, that spread's trading 2%. 5s, 30s is trading 2%. But what I want you to see is this is the fight and this is the knob. 5s against 10s, 10s against bonds. And I put it here. So this is the fight and this is the knob. Okay? Fight, knob. So this chart here plus this chart equals this chart. Does that make sense? Are we able to follow that? So this chart here is 5s all the way out to 30s. This is 5s to 10s. This is 10s to 30s. So this chart here plus this chart equals this chart. It's a part of it. This is the puzzle that we're putting together. Because if this was really weak and this was really strong and this was a flat line, the reason this is really strong is because of the knob. And the beginning is, well, the reason this would be flat would be because the knob is really strong and the fight's really weak. Putting it all together. The values are not just the index added together. We have to do some math behind that. But what I want you to see is this plus this equals this. Jimmy, thank you. You can do that as a Forex equivalent. Euro US against US Japan. You can do it as like iron condors for options. You're trading butterflies. You're trading highly correlated instruments, and you're waiting for those relationships to break down. When they break down, there's possibly a trade opportunity. That's what we're looking for. Jimmy, you get it. That's exactly how you can think of it. Okay? And then I call this a triangle because we know what 530s is. Now, if we can put it together, we can value it. You learn to do that over time, you get more confident. And this is something that you can grow into. It makes sense. Here we just have the 5-year butterfly on top and the 10-year butterfly on the bottom. Okay, just keep showing more like similar type examples. Great question, Matt. Matt says when you sell one and buy the other, can you profit in both of them? You can, but it doesn't matter, right? It doesn't matter if, let's say we make $10 and we do 2 trades and we make $5 on one and $5 on the other. Does it really matter if we make $10 on one and 0 on the other? Or if we make $13 on one and lose $3 on the other? It doesn't matter. The point is that it's one trade. Okay? Well, Preston, I'm gonna get into that about the benefits of using Sierra charts because I think you'll see in short time that it's kind of a no-brainer. Keep pressing forward. I think you guys get it. And I also think this is the exact same slide that I had before. So there's no reason to explain it. Let's talk infinity against, say, Thinkorswim. Okay? Again, guys, I don't work for Infinity. I recommended my members go over to Infinity because they do margin correctly. That's the only reason. I reached out to Patrick because they do margin correctly, and whoever's moving forward, and I'm teaching bonds, look at the difference. So ZB against UB, which is the BUB, which is this thing, which is one of my favorite trades. All you're doing down here, you're buying one ZB and selling a UB. That's the trade. If I did that trade in Thinkorswim, if I did a 1 lot, it's 13 grand of margin. $13,000 of margin. Infinity would charge $2,000. That's the big difference. Now, yeah, there's more risk, I guess, because you can do 5 by 5 for the same that you can do for TD Ameritrade. But TD Ameritrade does this wrong. Before I even got into the retail world, I didn't know anybody does this. I just assumed everybody does this. Sherry, my figures are wrong for TD. Use this as an estimate. So, Sherry, but these are butterflies. There's 3 products in them. Nevertheless, use it as an estimate, guys. I'm not a broker. I just want to show you the key is Thinkorswim is going to handle one contract at a time, right? So if you're long one ZB and short one UB, they're going to treat them 5,000 and 5,000 as 10,000. What Infinity is going to do, and I don't know the exact math behind it, is they're going to do whatever the exchange relationship is. And that's how they're going to do their margin. Yeah, it's constantly changing, of course, but this is going to give you a good idea. And it's a pretty significant discount. And again, I have a lot of my advanced bond students on here. I would say all of them are clients of Patrick, working with Patrick because of this. This is just ridiculous. But again, they don't specialize in futures. Okay? So as we go over this, guys, is this making sense? Can you see the difference, though? Can you see the difference in an approach like this? Because I've seen others on the internet teaching or selling a program of trading bonds. One program teaches if bonds go up 16 ticks, sell it, because then it's going to come off 8 ticks. That's not real, right? That's just something that people make up, okay? How this is we're valuing different points on the yield curve relative to one another. Hopefully when you take a step back and again, put that common sense hat on, it makes sense because that's what we're looking to do. Okay? I asked my members this. I asked once, how many webinars has everybody been on? Because I know some are spending a few hours a week going to presentations. What I want to encourage is that's not really work, okay? It could be a waste of time. What we need to do when we're trading is find something that we believe in, invest our time, really learn it well. And that's why I encourage everyone just to keep it simple. If you're doing something that's not working, stop. If you feel like you're stuck in trading, if you feel like you're willing to do the work, but even hard work doesn't pay off, I'm here to tell you, it's probably not your fault. But if you learn the wrong thing, it doesn't matter how much you're working. Wrong is just flat out wrong. Okay? So let me get into Bond Bootcamp, tell you exactly how it works. Bond Bootcamp covers everything you need to understand this trade. You'll end up watching it a few times. You'll ask questions. You'll watch the videos. And over time, you'll get more and more and more until you finally say, wow, I get it. Okay? So here are the benefits to learning how to trade bonds. For one, lean on my experience. I'm here to help you. Two, it's a ton of fun because you can get creative. That's what I love so much about this trade. For me, I like to trade options too because you can be really creative trading options. You can be really creative trading fixed income. Once you learn it, it's very straightforward. I got to tell you, like anything in trading, the challenge is not learning the material. The challenge is being able to learn how to trade it confidently. Anybody can learn the material. The challenge is to be able to trade it confidently, to work on your entry points, to work on your discipline. Diversifies, I doubt it's correlated to anything that you're doing right now. And personally, I believe this gives you the foundation to trade bonds forever. So here's how it works. Everyone who moves forward, you get Bond Trading Bootcamp. I have 2 kids who game all the time. They're video game players, so I speak in video game parlance a lot. The workshop is broken up into 3 levels. Level 1 is all about outright trading. I teach you the personality of each contract. The ZT, the ZF is very different than the ZB or the UB. Level 2 is about spreads. We look at different relationships. And level 3, we get into yield curve valuation. We really dig into the yield curve valuation. It's 3 hours of content. Okay? Not sure what to value it at. Call it $9.97 because you really can't learn it anywhere else. It also includes a bond spec sheet that goes over each contract, the margin, etc. So I didn't put too many testimonials on here again because Infinity is very cautious about that kind of stuff. I did throw in one from Byron. Again, testimonials, they're just individual experiences reflecting real life, their personal experience. Just because Byron had a great experience, that doesn't mean everybody else will. Okay? So this is what some say, maybe it's just bad timing. All I ask is think about what you're doing now and is it getting you on the path that you want to get to? Okay? Are you still trying to make trading work? Maybe you feel like you're getting closer, but the only thing holding you back is it's a bad market to trade. That's not real. It's not a bad market to trade. Markets are constantly trading and we need to evolve with them. Okay? So let me get into part 2 of this offer so you guys can see everything. Part 2 is a 90-minute program that we call Fed Dominator, okay? Fed Dominator teaches you all about butterfly construction. It teaches you how to build the charts and teaches you all about the outright trading. This used to be a separate product, but we coupled it together, okay? So you get everything. You get the 3 hours of Bond Bootcamp, and you get the 90 minutes of Fed Dominator, okay? Part 3 of this offer, guys, is going to be last month. We had a live bond class for everybody who's taking part in Bond Bootcamp. Anyone who moves forward today, you guys get the recording of that Bond Bootcamp class. It's another hour of content. We do the Q&A, yield curve overview, and we talked about actionable trade setups. So if we put it all together, you guys get the 3 hours of Bond Bootcamp, the 90 minutes of butterflies and outright trades, and a 60-minute live class. So what's that? We're up to 5.5 hours of content that you can start watching immediately. Let me also add, I reached out to Patrick to get this going. And before I reached out to him, I was sending lots and lots of clients over because I really knew the benefit of Infinity. I also know that the way Infinity handles margin is what we should expect. It shouldn't be the outlier, but it is, and it shouldn't be. After working with Patrick, and Patrick, thank you, he's been awesome. He's able to replicate all of these charts from TAS onto Sierra charts. And he got everything down to even the coloring. As for capital to get started in this trade, I think you can open up an Infinity account for $3 grand. And what I want you to do is use Sierra charts, learn on paper. There's no reason to lose money while you're learning. Okay? Keep getting these Skypes. Always learn before you start trading real money. Before I get into the pricing, guys, and I think the price will surprise you, I want this to be a no-brainer too. So I'm also throwing in a live class. Okay? Some more client testimonials, which I'll zoom through. And then we're going to do a live class at the end of the month. So for anybody who wants to do this, you get 5.5 hours that you can watch immediately and a live class. Again, Bob, the live class is for anybody who's ever bought Bond Bootcamp. So for those who have been with me for a year and you bought Bond Bootcamp 12 months ago, you got a live class at the end of the month just for being awesome. Okay? So the entire offer, guys, you get 5.5 hours and you get a live class. What I would like to do, think about what you would value this. Okay? Theo, my pleasure. Think about in your mind what you'd value this offer at. What price does it make sense for you? If all this investment did was protect you from another approach in bonds, what is it worth? If all it did was show you what a really good trade looked like, showed you that if you study, you can find a really good approach to trading, what would that be worth to you? Well, today, for you, and as a big thank you to my good friends from Infinity, $297. $297 gets you a 5.5 hours of training, and you get a live class that we're going to do at the end of the month. Hopefully, and I think he'll say yes, we're going to have Patrick on there as well to walk you through any charting that you need for Sierra and to answer any of the brokerage questions. But for anybody else, it's activedaytrader.com/Fed. This is an awesome program that many have had a ton of benefit, and hopefully you'll see the price as being, a fair, respectable price for you to learn. Lots of questions coming in that I missed. I'm going to go over all the questions, and we'll hang out here for as long as you need. Okay? Is there seasonality to bond trading? Nah, not really. Kathy, especially when the Fed's moving, there's real opportunity in bonds. Kunal, the link's not working? Let me see the link. So it's going to be activedaytrader.com/Fed. There you go, that works. No, we also threw in a 30-day membership. It's free. You just have to hit add to cart, and you can do that. What I do with the membership, guys, is every Monday evening, I share my game plan for the week in futures. So I share lots of bond trades as well. activedaytrader.com/Fed. Peter, what about the Boond? Great question. The Boond, the bubble, the shots, that might be something that we teach eventually. Okay. Can I give a trading plan now? No, because you're going to be overwhelmed and you're not going to understand it. I'm not sure what Bloodhound is. Do I ever do naked trades? Very personal question. Like, do I ever just do outright trades? Yes, we teach that all in Fed Dominator. Jay's asking, with all the fees, how much can we look to make daily or swing trade as an example? Jay, that's impossible to answer. This trade, guys, it needs to be learned. But for those who are really looking to put the time in, who want to learn something really cool, you'll love it. Think of it more as swing trading. We do go over, there is intraday opportunities, but I like to think of it more as swing trading. JJ, for that kind of information, if you want, you can just email me at support@activedaytrader. JJ is asking about some metals questions and some oil questions. Hey guys, if you asked a question earlier, if you wouldn't mind putting it in again, because the older questions have scrolled off. I'm going to go with the new questions first. Carl, if you purchased Bond Bootcamp in January, it's the exact same thing, and I'll see you in class. So again, guys, you get the live class at the end of the month. If we do a live class in 2 months, you guys are invited to that as well. What edge does this learning give you? Hopefully you can see it teaches you how to value the yield curve. It's a sophisticated trade. Oh, Theo, thank you. I appreciate that. A client of mine is very sweet and wants me to mention how accessible I am. So thank you very much. That's where Patrick and I do share a lot of similarities. We're both very quick to reply. Force a habit for me. But again, this is very different than anything that you've been exposed to. And it's on me to help you learn it. So I'm available. That's very important to me. That's also why we're doing 5.5 hours of content and the live class, because I want you guys to see that there's no nonsense. I'm not going anywhere. Hey, John. Patrick, if you can help John with your contact info. Hey, John, this is another great question. I'm pretty much a beginner. Is that a concern? John, I've presented Bond Bootcamp to over 1,000 people. Not one person has been familiar with this trade before I presented. So that is absolutely not an issue at all. Hey, Jay, so the Premier membership is something that's totally different. The Premier membership, for anybody who goes forward with Bond Bootcamp and you click that button, you get a free 30 days. After that, it's $97 a month, but you have the option. You do not have to continue. You can cancel anytime. You can move forward with the 30 days and cancel right away. Okay? Hey, Preston. So, never done spread trading. A lot of people think that it looks complicated, right? But it's not. It's just unfamiliar. I think we often think just because things are unfamiliar, they're complicated. This is not the challenge is not learning the material. The challenge is trading. And that's how it is in all of trading, guys. When I would interview people, I would never be looking at whether they can learn the material. I would be looking at, do they have the temperament to do well trading? And for me, that looks like, can they admit fault? Are they honest with themselves? Are they willing to put the work in? Are they willing to paper trade? David, thank you very much. Hopefully I can read. So David, another advanced bond student, was a beginner last September, knew nothing about trading bonds, and he's been quite successful over the last 9 months trading this method. So guys, just to be clear as well, this is the foundational course. I have 2 bond bootcamp programs. This is the foundational bond bootcamp. It has everything you need to learn about the trade. I also have an advanced bond room. The advanced bond room doesn't share any new information. This covers every single bit of information that's in advanced bonds. The only difference is advanced bonds, there's a private Facebook group for all my advanced bond students. Okay? You need to go through bond bootcamp before advanced bonds. Right now, there's a waiting list for advanced bonds, so it's not even open for anybody. But if that's something that you're interested in, you know, we could put you on that waiting list going forward. Okay? But again, there's no difference. It's just everyone's trading bonds is in one mastermind Facebook group. Hey, Kathy. We cover intraday bond trading in addition to swing trading. Absolutely. The intraday bond trading is going to be more of the outright trading. Peter is asking if I play the news. I don't gamble, guys. I don't. I look for inefficiencies in the yield curve. And if news creates those kind of inefficiencies, I'll put a trade on. But I don't bet on things going higher or lower. I don't speculate. I look for a value. And even when I do trade outrights, which is just one product, I do that by analyzing the yield curve and finding out which is the most expensive contract, which is the cheapest contract, and then for my outright trade, this is annoying, I make sure that I'm in the right contract. And that's really what it comes down to. Those little subtle differences in your trading. I think I keep getting kicked out. Jay, do the swing trades require monitoring? I don't think so. What is going on here? Let me just close these windows. No. A lot of these trades, no. Cancel. A lot of these trades we're going to put on, and they'll be 2 days, 3 days, 4 days. Constantine, I will show you trade opportunities for today. I'm not going in and showing, I don't show my personal account. I don't trade in front of you. I teach you, I educate you. That's what I do. I don't have live trading rooms. Okay, I will help you learn how to do this trade. So if we go back, here was today. Here was today, the bond contract rallied, the 10-year contract came off. Daniel, what's the spread trading like if I traded several contracts at once with all repercussions? Daniel, I'm sorry, I don't understand that question. Daily, weekly ROI potential. I mean, I don't have real data, guys. I would just be making something up, and I'm not going to do that. Again, this trade needs to be learned, like others before you who have come in without any experience whatsoever, you'll end up understanding the trade and taking hold of the trade. So right here, guys, this is the bond butterfly, and this is the 10-year butterfly. I would never buy a ZB at any time when it's up here. I would only look to do it down here. 10-year futures contract, I would never buy a 10-year futures contract with it up here. I would only do it down here. Okay. Again, a lot of these questions would be helpful if I can show testimonials from clients, because clients have had some really great success with this trade. But I really don't have that flexibility. If you have additional questions, Preston, please just email me at support@activedaytrader. Is $3,000 enough to trade this? $3,000 is enough to open an account with Infinity, I'm pretty sure, and it's enough to paper trade this for free. I wouldn't do this with just $3,000 though, for me personally. Okay. All right. Guys, if we missed any questions or if I missed any questions, just email me directly. Sure. So the trades today, so what I did is Monday, I share trades. And today, I shared a Premier alert to members to consider taking off those trades. And I'll show you exactly what that Premier alert looked like. Let me take this off screen for a second so I can show you exactly what I sent out to Bond Bootcamp holders today. There you go. Patrick, hopefully you're okay with me sharing this. Premier member alert, Bubs, Knobs, and Bonds. ZBUB, 12 ticks. ZNZB, consider taking profits as well, 10 ticks. We had the bond butterfly. These trades were open for 3 days. Okay? We got that, and then the advanced bond room will look like this. Here, Steve, all acting as we expected. Nice. Okay. This is what the advanced bond room is. We're just talking about trades all day. Okay. Again, everyone's going to have different results. Hey, Guido, how's it going? Peter, how long is this offer open? I don't know. Good question. We're going to do a live class to be determined. The live class will most likely be, I don't know, 10 days, 15 days. I just got to talk with Patrick about scheduling. What's going on here? Okay. Hey, Kathy, great question. Kathy's asking if this only works with bonds or can you do this with other products as well? So this works very well with bonds. When I'm trading other products, I am always valuing against something else, but it's a little bit different because what we're doing here is we're trading a curve, right? So unless a product has a curve that goes out, it's really difficult to replicate this exact strategy. So like oil has a 3-year curve. You could trade the oil curve. Many do trade the oil curve. But for other products like gold, I always look at gold against silver. Which one's expensive? Which one's inexpensive? Then you can look at the other metals as well. Platinum, palladium, not as good of liquidity, which is a concern. But whenever I'm trading, I always need to value it against something else. I never look at anything in isolation. and that counts for futures, stocks, ETFs, options. Oh, Guido, fantastic. But Guido, you moved forward with Bond Bootcamp like over a year ago, right? It's a good way to kick it off because you get a live class again. How many? Oh, you're in advanced. Okay, so Guido, perfect example. He's been in my advanced bonds for over a year. He lives in Italy, has always had problems with charting. Now he can use Sierra. And now I got Guido back. That's great. What's my win percentage or win ratio? It's going to be misleading because my win ratio and your win ratio are going to be very different. We try to trade for a high probability. Okay, when I get into bond trades, my objective is to make money on a lot of them. A very, very high percentage is what my objective is. But I don't want to just sit there and say, hey, it's 50% because I'm not going to show you hardcore data behind that, so it's going to be very misleading. Jay, I'm not with Infinity at all. Patrick, I'll leave that one for you, but I think you get it free with Infinity. More margin questions. I'm going to have Patrick answer those.
Yeah, let me answer a couple of these real quick here, okay?
Yeah, take your time.
Let me introduce this now just because a lot of the folks here, these are good questions. So what I'd like you to do, for those of you who already have an account with us, or if you don't have an account and you want to try this whole setup out, send an email to your rep in our office here. So it doesn't matter who it is, or if you don't know who it is, that's okay. It's who just reply to any of the email you get from Infinity. That'll go to the right person, and we'll get in your hands a link to the trial if you don't have one already. We'll give you a couple of the, like a good starting point for the charting in terms of like a spread chart and then a butterfly chart. And then we'll give you copies of the 2 PDFs. One of them was the list of interest rate spreads. The other one was the margins that we had quoted, that we were showing earlier. So that'll give you a good solid starting point. The way that it works with margin, guys, is 3,000, as Jonathan said, is the minimum to open the account here. And the Sierra charts that we offer come with the account, and the pricing is like this. If you do 10 round turn trades, like buy one contract, sell one contract 10 times in 30 days, then the fee that we would otherwise charge for the charting is waived, and that fee is $20. So if you're doing a minimal amount of trading with us, 10 round turns in 30 days is not a ton of volume. You're not going to pay the $20 fee that we would otherwise charge for the charting. So the charting and the trading platform, Infinity AT, which is our execution software, come wrapped into one download. You launch the trading platform. If you have chosen to use the charts automatically come up. So it very much feels like one setup, but they do function as 2 separate applications on the computer. They're very light. Thinkorswim is a resource hog. This is a super light application. You really shouldn't have any trouble running it alongside anything you're already using, and we can train you on it. We do very good support for Sierra. So hopefully that clears it up. Anybody who wants to try it, again, all you need to do is email, just push reply. Any of the email you got from Infinity, any confirmation email, the webinars, just push reply, and just let us know you want to take a look at it, and we'll get you everything you need. So
let me also throw this out there too. If you move forward with me, guys, and it doesn't work for you, 30-day, no questions asked, money back guaranteed. Okay, no BS at all, and I'm saying that with Patrick on the line. So for 30 days, if you move forward with this, if you don't like it, if you don't like the sound of my voice, whatever it is, no questions asked for 30 days. So make it kind of a no-brainer, offering everything, including the live class. Go get a demo with Infinity, take the program, and start playing around with it. Just paper trade. It costs you nothing. Go through all the education, and then if you still hate it and it still is like, oh, I'm never going to get any use out of it, support at Active Day Trader. Okay, it's just me and my wife here. I don't have like a 20-person educational company. I work with clients. I want this to work for you, and if it doesn't work for you, it doesn't work for me either. Um, Patrick, you can feel free to jump in whenever. I think a lot of the questions coming in are more for you at this point than for me.
Sure. Guido. You'd have to move that account over here, Guido. You'd actually have to move those funds here. I don't know how much money you have there. You don't have to share it with me here, but you would have to move it over. But the minimum to get a new account going here would be $3,000. Okay. Manmohan asks, this is a pretty good question. Do you guys stop us out of trades if there's a huge loss? We have a daily risk limit on our accounts. Daily risk limit is like a dollar amount where if you lose X amount of dollars inside of one session, that our system is going to try to liquidate. Generally speaking, we usually start that off around 60% of the value of the account. So if somebody has $20,000 in the account, and that's $12,000. So if you're ever in a situation where you're down, $12,000 on a $20,000 account, obviously that's a horrible situation. That's where we're going to try to step in ultimately to try to prevent a debit. The goal of that is to protect the FCM, protect the customers from a negative balance in the account occurring. It's not guaranteed to work, so don't lean on it as a stop loss. But it is, it's nice to know that there's a circuit breaker there besides just yourself, in case some anomalous event happens, a stop gets ripped through, or who knows. That is a risk system that we've had in place for quite some time, and that number can be tightened. So you don't want to reduce it to $200, right? But if you wanted to reduce the risk limit on your account from if it were at 10,000 and you say, okay, Patrick, can you change my risk limit to 1,000? We could do that because we have the capability to be flexible. Again, it really is just an extra layer of security, a circuit breaker. It's not guaranteed, so don't use it as a stop loss, but it is flexible. Bob, that question about the interest rate, is there even a limit on bonds? I don't even know if there is a limit on bonds.
It's so far away.
Yeah.
Bob, not an issue. Not an issue.
Yeah, that's not, what Bob is asking is if there, what happens if there's limit up, limit down type situations. You could see limit up and limit down in any market that has limits. Like the most, when people think of limit up and down, they usually think of the grains, which is something you certainly do want to be more conscious of if you're trading commodities that have weather or agricultural or USDA impacts news. I don't really think I've ever seen anything like that in the interest rates. I don't even know where the limit would be, to be quite frank.
I remember when they introduced the new 30-year bond.
Right.
Yeah. I think it might have hit something, but so the way these trades work, guys, is we go into unemployment flat, we go into Fed flat. You don't really want to position going into those. They're binary outcomes. We want to wait till that information comes out. We want the market to settle, and then again, we're just looking for little kinks in the yield curve. We're just looking for little inefficiencies. Okay, we're not looking to save the world, right? We're just sitting around. So how this trade works, and I think that this is the most difficult thing for people to understand, and I say this often, it's an entry point trade. So we'll know which is the expensive contract and which is the inexpensive contract, but you really want to have that discipline so you can wait for really good levels, because it's just entry points. Being able to hold the position, being confident that you're in the right position, and you just don't want to be in a situation where you're itching to trade and you get in way too early, and then it goes against you, and then you're missing out on the best levels because you were antsy and needed to get in so soon. That's why when I'm teaching, you'll hear me say that quite a bit. It is an entry point trade. Patrick, is there data fee?
Manmohan, okay, data. So the CME charges yes, there is a data fee for CME data. If you only need the interest rates, it'll be $6 a month. If you need to get into other markets like crude and gold and so on, it can go up to $18. So 18 is the highest you can go right now for CME products. If you want to look at, someone mentioned Eurex earlier, the Bund and the DAX and things like that. We offer that as well. The Eurex exchange charges €21 for their data, but that is optional. You're going to have a choice when you go into your account the first time. of what products you're enabling, and you can always pick and choose and mix and match. So if you want to start out with just the interest rates, keep the cost super minimal, $6 a month, and the next month you want to add, the NASDAQ and the S&P or whatever, you can always do that with us. So the most you'll pay for CME data here is $18 a month. David, you may have missed this one earlier. There's you can't place the order as a spread. You have to leg into the spread. David is asking if you can place an individual order. You have to leg into the spread. Jonathan has kind of an order of operations, so to speak, of what he recommends of how you enter that position. But we can obviously chart the spread. So entering the order is usually done. Usually for most people who do it this way, they usually go limit on one side and then market on either the other side or the two other sides. That's Jonathan, that's probably accurate, correct?
Yeah.
Right.
And right now, at least from what I'm seeing in the market, professional trading shops do have spreaders that work well. Some of the retail platforms have tried to create their own spreaders, but they're not good enough yet for this type of trade. So you're better off just doing it by hand. Just going over a question. So as far as stops, and again, that's why I really want you to paper trade. First of all, learning anything new, paper trade, paper trade, paper trade. But as far as stops, before we stop ourselves out, I want to teach you how to protect the position. So that's what we're doing. We're always looking to play defense. We're always thinking about how can we protect the position, how can we play defense, what happens if the yield curve steepens, if it flattens. So we want to protect our position rather than just use stops and kind of everybody out of the pool. As far as using a stop, though, I mean, obviously, you know what your risk is, so you have to back into it. So if you're comfortable or you can risk $1,000 on a trade, you need to look at where you would get in, and then at what point would you be stopped out, and see if that trade still makes sense for you. For me, I think stops should be traded with a purpose. So I'll back into it and figure out at this level, I'd want to put a stop because my opinion changes. And then that's how I would back into a trade. I wouldn't get into a trade and then just put an arbitrary stop based upon P&L. But that's me. This trade, it's 23 hours. You can trade it whenever. There is no best time of day or worst time of day. Steve, ballpark the percentage of trades which are held overnight, which involve entering more than one instrument. That's going to be up to you. What we teach is how to do this outright, so you can do it with one instrument. You can hold it overnight. If you don't want to hold it overnight, that's up to you. I have many who are just trading outrights and prefer not to do the spreads. Again, so Stephen, and I hope that answer doesn't sound, vague. I don't want to just give an arbitrary answer that's that is irrelevant without real solid data. So.
Right, and guys, keep in mind too, just like trader, when you talk to someone who's got a great degree of experience doing this sort of thing, and I feel the same way when I get asked questions like this too, this is a very contextual way of looking at things. It's really hard to just stick it into a spreadsheet and box it in like that. So, the questions these are good questions, but they are very hard to answer. And I can tell Jonathan's not trying to be wishy-washy. It's just hard to explain because every situation is going to be a little bit different. And I've been there myself. Some of the strategies that I've followed, there's a lot to it. And sometimes there's a circumstance where something applies and it very obviously doesn't apply in the next circumstance. On paper or in a spreadsheet in Excel or something, it's really hard to to pin that down. So I get it.
It's funny, Patrick. I appreciate you pointing that out, because I'm really trying to be more transparent by giving you that answer rather than just saying 20% we hold overnight versus 80% we don't. That's when I think that people that's where my BS meter really rises. And what I say often, kind of comparing it to options trading, if we had 10 traders, we're going to have 10 different results. It's just a matter of how do you manage your trade? Are you going to stop yourself out, or are you going to protect yourself? At what level did you get in? So all these questions factor in, are inputs to the answer.
Right. Yep. I agree with that. Okay.
David,
Good. Well, I mean, do we? Is there anything else, Jonathan? You thought we should cover before we wrap it up?
No, this covers it all. As a couple of questions, David. Thank you very much. 297 for this knowledge and perspective is a no-brainer. I appreciate that. We haven't talked about income potential for a small account size. Again, that's
impossible to answer that.
Yeah,
impossible to answer.
And if anybody answers that, they're just making it up. So you can. Another thing that I'm always going to teach is paper trade. Give yourself a goal of $300 a week on paper. If you can accomplish that, go try to make $700 a week on paper. If you graduate that, then trade real money. So keep trying to prove to yourself that you can get over these different hurdles, and it's going to answer your own question about, is it a viable strategy for you? Are you ready to be in the market? Or maybe if you can't make that $300 a week, hey, you got to go back and grind. You got to go back and learn. Yeah, Peter, on YouTube, just search active day trader Jonathan Rose. I have probably 20 videos on bonds, and then Patrick put up some on the Infinity channel as well.
Right.
I'm good though, Patrick. Guys, if anybody has any additional questions for me, Jonathan at Active Day Trader. That's it, guys. Thank you. Appreciate the questions. Thanks for everybody coming out. Sure.
All right, cool, excellent. Well, thank you, Jonathan, for doing that. Let me, I'm going to take the screen back here for a second. Again, anyone who might be interested in taking a look at this on our side, we have the simulator. It's free. It's got real-time data. There is virtually no reason to not give it a look. If you're an existing customer, just again, we'd love to have you look at this stuff, and all you need to do is email your rep. We'll get you everything you need. If you're not a customer of ours, or if you're thinking about it, a lot of familiar names in here. Obviously, this might be a good reason to finally give us a look. The simulator is free. It's got live data. It's a really nice way to check things out. So we'll give you a good, solid starting point. We'll get you all the margin info. We'll get you some good starting point on the charts. We'll show you how to import the files into the correct folder so you can open them up inside the charting platform and just really get right into it. All right, so let me go ahead and read some risk stuff one more time. Really appreciate you guys coming aboard here and taking a look. We'll close the room after this, and then we should have a recording available on YouTube within, I'm guessing, a couple of days at the most. And anyone who registered, we'll get an email out to you. All right, so Jonathan, thank you again for your time. Very much appreciated. I look forward to helping you out with that class at the end of the month. And everybody else who attended, especially those who are still here with us, thank you for listening and for your time this evening. And we'll see you next time. All right?
Awesome. Thanks, Patrick. Thanks,
all right, guys. Sure thing.
Bye-bye.
All right, folks. Trading futures, options on futures, and retail off-exchange foreign currency transactions involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you. In light of your circumstances, knowledge, and financial resources, you may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. All right, guys. Thank you very, very much. And gals, have a great night. Bye-bye.